Hey guys, it's Colin Burr. Looking into the financials of a company can feel intimidating. Trust me, I've been there. That's why I'm breaking down financial due diligence into bite-sized pieces. This isn't just about numbers, it's about understanding the story behind those numbers. In this video, I'm giving you my personal checklist, a roadmap to navigate the financial due diligence process. Let's get started. Let's kick things off with the foundation of financial due diligence, the financial statements. We're talking about the income statement, balance sheet, and cash flow statement, your trifecta of financial insight. Grab at least 3 to 5 years worth of these statements. You want to spot trends, both good and bad. First up, the income statement. This is where you see the company's revenue and expenses. Is revenue consistently growing? Are expenses under control? Next, the balance sheet. This gives you a snapshot of the company's assets, liabilities, and equity at a specific point in time. Finally, the cash flow statement. This shows how cash flows in and out of the business. Every company uses accounting methods, and it's crucial to understand how they impact the numbers you're looking at. Start by looking for the company's significant accounting policies. These are usually outlined in the footnotes of their financial statements. Pay close attention to revenue recognition. When and how does the company record revenue? Next, dive into inventory valuation. How do they value their inventory? FIFO, LIFO, weighted average? Each method has different implications for profitability. Don't forget about depreciation. How do they depreciate their assets? Revenue is the lifeblood of any business, so we need to understand where it's coming from. Is it diversified or concentrated? Is it sustainable? Start by identifying the company's major revenue streams. Are they overly reliant on a single customer or a handful of clients? Now, let's dissect their sales. Are they primarily recurring revenue from subscriptions or long-term contracts, or are they heavily reliant on one-time sales? Understanding the source and sustainability of revenue is crucial for assessing the long-term viability of the business. Analyze expense structure. It's not just about how much money a company is making, it's about how much they're spending to generate that revenue. Start by categorizing their expenses. What are their major cost categories? Cost of goods sold, marketing and sales, research and development? Next, look for any unusual or excessive expenses. Are there any red flags that need further investigation? Benchmarking is key here. Compare the company's expenses to industry averages. Examine cash flow. Cash flow is king, or at least that's what they say in the finance world. Start by analyzing their operating cash flow. This is the cash generated from their core business operations. Is it positive or negative? Ideally, you want to see a healthy and consistent positive operating cash flow. Next, delve into their investing activities. Are they investing in their future growth through capital expenditures, or are they selling off assets to stay afloat? Evaluate working capital. Working capital is like the oil that keeps the engine of a business running smoothly. Start by calculating the current ratio. This measures the company's ability to pay its short-term obligations with its short-term assets. A ratio of 2 to 1 or higher is generally considered healthy. Next, take a close look at their accounts receivable. How long does it take them to collect payments from their customers? A longer collection period could indicate potential cash flow problems. Then, examine their inventory levels. Investigate debt obligations. Debt can be a powerful tool for growth, but it can also be a double-edged sword. Start by listing all of the company's debts, including loans, bonds, and other credit facilities. Next, assess their debt levels. Calculate their debt-to-equity ratio and their debt-to-asset ratio. These ratios measure the company's leverage and financial risk. Then dig into the terms of their debt. Review tax compliance. Nobody likes talking about taxes, but they're a crucial aspect of financial due diligence. You want to ensure the company is playing by the rules and not sitting on any hidden tax liabilities. Start by reviewing their tax returns for the past few years. Are there any red flags or inconsistencies that need further investigation? Next, check for any unpaid taxes or outstanding tax liabilities. These could be signs of financial distress or poor management. Assess internal controls. Internal controls are the unsung heroes of financial management. They're the policies and procedures that help ensure the accuracy and reliability of financial reporting and prevent fraud. Start by reviewing the company's internal control over financial reporting, or ICFR. This is a framework designed to ensure the accuracy of financial statements. Next, assess the effectiveness of their key controls. Are they designed and operating effectively? Are there any gaps or weaknesses that need to be addressed? Then, check for segregation of duties. This means that no single individual has control over all aspects of a transaction. Analyze industry position. Understanding a company's financial performance in isolation is only half the battle. We need to see how they stack up against their competitors and within their industry. Start by researching the industry landscape. Is it a growing or declining industry? What are the key trends and challenges? Next, compare the company's financial ratios to industry averages. Are they outperforming or lagging behind their peers? Examine legal obligations. Legal issues can be costly and time-consuming, so it's essential to uncover any potential legal landmines during due diligence. Start by reviewing any ongoing litigation or legal proceedings involving the company. Are they involved in any lawsuits or regulatory investigations? Next, assess their compliance with relevant laws and regulations. Are there any areas of non-compliance that could result in fines or penalties? Evaluate assets and liabilities. Assets and liabilities are the building blocks of a company's financial position, so we need to take stock of what they own and owe. Start by reviewing the company's balance sheet. This provides a snapshot of their assets, liabilities, and equity at a specific point in time. Next, assess the quality of their assets. Are they well maintained and in good working order? Are they easily convertible to cash if needed? Related party transactions. Related party transactions are deals or agreements between a company and parties they have a close relationship with, such as executives, directors, or major shareholders. While not always a red flag, these transactions require extra scrutiny to ensure they're conducted at arm's length and in the best interest of the company. Start by identifying any related parties. These are typically disclosed in the company's filings and financial statements. A company is only as good as its people, so it's crucial to evaluate the management team and the overall workforce. Start by assessing the experience and track record of the leadership team. Do they have a proven track record of success? Have they navigated through challenging times before? Next, check the staff turnover rate. A high turnover rate could be a sign of low morale, poor management, or other underlying issues. Then, understand the organizational structure. Analyze forecasts and projections. While past performance is important, we also need to look ahead and assess the company's future prospects. Start by reviewing their financial forecasts and projections. What are their expectations for revenue growth, profitability, and cash flow? Next, scrutinize the assumptions underlying their forecasts. Are they realistic and supported by market data and industry trends? And there you have it. We've covered the essential elements of financial due diligence, empowering you to approach investment decisions with greater confidence and clarity. Remember, this checklist is your roadmap, guiding you through the intricacies of a company's financials. By thoroughly examining financial statements, understanding accounting practices, and scrutinizing key areas like revenue, expenses, and cash flow, you gain invaluable insights into a company's financial health and potential risks. This knowledge empowers you to make informed decisions, separating you from those who simply rely on gut feelings. Now is the time to invest in your greatest asset, your business and financial education. Let's thrive together in these trying times by taking advantage of this opportunity for personal growth. Join us. Click the link below for short, sharp, simple video courses that give you confidence and street-smart business skills to simplify accounting and focus on growing your business to succeed.